And just like that, stocks are back near the highs, and yet bonds are coming off, so yields are higher. Dollar is finding some support. And as we look across markets, we find ourselves very little changed across the major asset classes as we head into what is a meteor data week next week. But we're not done, because there's another piece of news here getting ready to cross the wires that may actually be quite a bit more impactful than anything else that we've seen this week, if only because there hasn't been a whole lot on this calendar that has really moved the needle. So what we're going to focus on today will be a very closely watched survey from the University of Michigan that tracks U.S. consumer confidence. And the question, as ever, will be, speaking to this dichotomy that we've really amplified and grown in really the spectrum of financial markets. You name it, it's there. From November into December, and of course, where we're idling now. This idea that we are somehow going to get a soft landing for the U.S. economy and an aggressive rate cut cycle. Now, generally, the Fed doesn't cut rates in a mad dash unless something is terribly wrong. And if we look at the U.S. economy here, it does not seem to be anything like that there, at least for the moment. So as ever, the question for us will be, which one of these assumptions is wrong? And what does that mean for markets? So let's start here with, first and foremost, what we're expecting from this data. Here's the backdrop here. So consumer confidence has been on the path toward recovery, basically right alongside the pullback in inflation expectations. So as the Fed started to raise rates in March of 2022, that's right here, we see that consumer confidence hits a bottom and starts to recover. As inflation comes in, consumers get more confident. No big controversial shock there. Now, there was a little bit of veering off into the skids in November and to some extent October as we got this jump in inflation expectations. It seemed to follow the preceding month's pop in crude oil, which of course echoed in energy costs. But that has faded now. And as we can see here, December saw a spirited increase in confidence as inflation expectations fell from 4.5% to just 3.1%. In general, though, we can see inflation expectations have been quite volatile all year, but the trajectory remains. They're still pointed lower. If we look at the expectations for these January numbers that are due to come in, we can see the current conditions index just a touch lower, the expectations index a touch lower, the overall sentiment index very little changed, fractionally higher, basically in the realm of a rounding error. And so the way that this seems to come together is inflation expectations are seen holding low, unchanged at 3.1% for the one-year inflation outlook, and the 5-year that we don't have on the chart here also expected to remain unchanged at 2.9%. So the U.S. consumer seems to be generally well anchored here going into January. Looking at the way U.S. economic data has been performing relative to forecasts, we can see that the outcomes as realized have converged on expectations. So that zero line in the middle of the chart is telling us that we have neither upside surprises nor downside surprises as the likely path forward here. That, of course, comports with U.S. economic growth expectations having been increased from about August through to now. And of course, over that same period, economic data has come in because you increase forecasts and it becomes more difficult for the data to beat those forecasts. And so we can see that we've had a kind of divergence that has been squeezed out. And now it looks like analysts' models are just about in tune with what the economy is actually giving back as realized results. So this would mean that whatever expectations we're seeing here, they're probably pretty good. They're probably close to correct, which again tells us a fairly well-supported, reasonably optimistic U.S. consumer is out there in January, much as it was out there in December. Now, this, of course, lines up with the overall story for U.S. economic growth. We can see here that the path for 2023 has been basically a play in two acts. From January to May, there is this pickup in the service sector. We can see here, of course, this is in the logic of PMIs as usual. So 50 is neutral, above 50 is expansion, below 50 is contraction. The further you go above 50, the faster the expansion. The further you go below 50, the faster the contraction. Take a look at January 2023, that's marked on the chart there. You notice that manufacturing from that point onward is basically oscillating in the same anemic contractionary range that it's occupied. It's not getting better, but it's also not getting worse. It's shrinking at a pace that isn't materially increasing. Shrinking though it is, of course. But most of the economy is not manufacturing. Most of it is services. And so what we see here is that the composite index that takes these two things together and gives you an overall perspective of the economy excluding agriculture, which is an even smaller piece of the pie than manufacturing, we see that the composite index and the service index are basically the same chart. It's the service sector that's really shaping outcomes here. And what we find is that from January through May, there is a pickup in service sector activity growth. And if we look at where this is, a lot of this is what's been called kind of revenge spending after COVID, where folks that were perhaps more defensive on those things that they were not engaging in during the pandemic and the lockdowns around it. So public events, travel, events that require one to be in crowds and outdoors or indoors, but in close proximity to lots of people or moving around in enclosed spaces. That seemed to see finally a kind of relief and pickup in the first half of last year. And then everything fizzled. So as we got from May to August, the economy basically arrived at near standstill. We can see we're hugging that 50 line at that point. Since then, flatline. We're neither shrinking nor really growing very quickly. There is positive growth, but it is very slow. And that has been the steady state for the economy really since August through to now. The latest data that we have here is through December of last year. So this lines up, of course, directly with what we're seeing here. From August through to now, we get economic data that lines up with consensus forecasts, because as things idle in place, we get analysts having enough room to kind of adjust what they're looking at and give us a more accurate view of conditions. This further reinforces this idea that U.S. consumers seem generally upbeat. They don't seem to be terribly perturbed by the economy being slow, which again reinforces this idea that these sentiment numbers are going to be relatively anchored when they come out. Data we just saw today on jobless claims is even more support. Here's initial jobless claims falling significantly, and continuing claims, the one that we've been really focused on most acutely, because it suggested that people were starting to have a bit more of an issue finding jobs once they became unemployed. We saw that here. That seems to be rolling over. And the latest weekly continuing claims number is through its 4-week average, through its 12-week average. It seems to be suggesting a stronger, or at least a somewhat strengthening U.S. labor market. So that, of course, also a positive story for consumers. Now, this is why this conversation is important. Consumers are by far the most important catalyst for U.S. economic growth. As we can see here, the latest numbers from the third quarter here tell us that the share of personal consumption expenditure in GDP is just about 68%. And that it's basically held in this range of about 67 to 68, really for the past decade. That marks a kind of steadying of a trend that began in the 1980s, where it went from 60 or so to now close to 70. But what this clearly says is, as the U.S. consumer goes, so too the U.S. economy goes. And as the U.S. economy goes, of course, so too does the global economy go. Because the U.S. is, to put it conservatively, about a quarter of global GDP. But if we consider how many other economies are vendors servicing U.S. demand, and whose contribution to growth depends on there being U.S. demand, of course, the most critical one is China, which itself is close to a fifth of global GDP and the world's second largest economy. But of course, the list of dependencies is vast, whether we look at direct dependencies like Mexico and Canada, or de facto ones that that are dependencies both directly or through China as a kind of middle step in the global supply chain. The impact here is outsized. And so if the U.S. consumer is relatively optimistic, if the labor market, at least based on the most recent numbers that we saw today, seems to be a little bit friendlier, then a natural question must, of course, arise. We've spent really the better part of the past 3 months speculating aggressively in the financial markets that the Fed is going to cut interest rates in a blistering hurry. So what you see here is the S&P 500 as a kind of benchmark for overall risk sentiment in the dark blue line there. And the gray bars are the expectations for how many rate cuts are now baked into Fed funds futures between January and December of this year. And what we see is that between late October, early November, through to the end of last year, the S&P is on an absolute tear higher. And that the catalyst for this, by all accounts, seems to be the swelling in the number of expected rate cuts from about 3 or about 75 basis points to now closer to 6, anywhere between 1.5 and 1.25 of a percent. So what this suggests is that we've just experienced 3 months of a rally contingent on the idea that the Fed is going to rapidly reduce interest rates this year. After all, the Fed only has 8 meetings, and there's an election year this year, which means that the political cycle dictates we can only have so many of these meetings be policy change meetings. The Fed doesn't generally want to weigh in immediately around an election because it doesn't want to skew outcomes. It doesn't want to become politicized in any way. So we only have so many opportunities for the Fed to actually move rates this year. And the expectation is that of the 8 meetings, we're going to get, give or take, 6 cuts. That is a tremendously rapid easing cycle, which of course stands very much in contrast with what we're seeing in consumer confidence and the implications for growth therein. If the U.S. economy is doing not great, but okay, if it's not shrinking, if growth has stabilized, albeit at a low level, because of course the Fed has been raising rates and slowing growth, it is not a bug, it's a feature. If that's what's going on here, and now the Fed is going to cut, so the growth picture is going to be even better, but U.S. consumers aren't perturbed either way, then do we really need 6 cuts? And if we don't need 6 cuts, does it make sense that stocks are here, considering it's the 6 cuts that got us to these heady highs? So herein another test of this familiar disparity that still seems to have financial markets somewhat confused. Now, not all the data is perfectly rosy. Not everything screams of excellence for the consumer. For example, if we look at credit card delinquency data, we can see that delinquency rates have been marching very steadily higher for both 30-day and 90-day credit card delinquencies. We can see that the turn there anticipated a turn in overall loan delinquencies, which has been marching steadily higher as well from basically the second half of 2021 to now, and is now hitting levels that are essentially ahead of COVID. So the situation is certainly not altogether rosy. It might very well be that a lot of this optimism from consumers is a function of them spending down credit ability. And once you sort of get to a point where delinquencies get high enough, you can't power consumption that way anymore. You need growth. The latest ISM numbers that we saw, they have a very worrying story to tell here about service sector employment. We can see here a massive decline in the services employment index, deep into contraction territory. This is, again, in the logic of PMIs. So what we see here is that the orange line, the service sector employment component, it was hugging that line really for the entire several years since the rebound from the lows of COVID. It has now essentially fallen off a cliff and is showing that we are losing service sector hiring at the fastest rate since the second half of 2020. Not exactly a ringing endorsement for the fate of the consumer. But these are, for now, hypotheticals. Because if we look at jobless claims, which are relatively hard numbers, well, they're going the other way. There are not more claims because employment is being shed, and continuing claims are down as well, as we just saw, which tells us that those people that are filing are not refiling. So they're finding jobs relatively quickly. At least that's been the story here most recently, essentially going back from October through to now. So, at face value, yes, there are risks. Loan delinquencies are a risk. The ISM data is a risk. There are concerns here, to be sure. But consumers don't seem to have noticed, and the hard data doesn't seem to be rolling over. Not yet, anyway. So, with that in mind, you get a set of numbers like this, and that lingering question about whether stocks have sustainability on the basis of aggressive easing, that question resurfaces. Because if indeed these consumer sentiment numbers are going to come out reasonably well supported, well, then perhaps we don't need 6 cuts or 5 or 4. The Fed itself is arguing for 3 in its latest update. That would imply a very significant readjustment in those gray bars back to a higher setting, so back to somewhere around where we were in September, early October. And if this relationship holds, that would comport with a significant adjustment lower in stock markets. Bond markets seem to have already started this move, in particular at the long end. We'll see if that finds follow through. But perhaps the most interesting overlay to all of this is a familiar chart that we've been looking at here for the past several months, and that's the VIX volatility index lagged 24 months against the Fed policy rate. And what we see here is that just about 2 years on average after the Fed starts a rate hike cycle, there is a spike in the VIX. Now, we should take this with a grain of salt. The sample space is relatively small. There are only so many Fed rate hike cycles that we've seen since the dawn of the modern financial era, going back to, let's call it, the late 1970s, early 80s. But we are right in that window just about now. The Fed rate hike cycle started in March of 2022. March of 2024 will be exactly 2 years, which means that we are somewhere in this window at this point. The 2 months going into March, maybe about the 2 months going out of it. We are right in the window for where stocks might spike. Lower, that is, as the VIX goes up. And so the interesting element to this seems to be that if the markets are right on the 6 cuts, then something very untoward is envisioned on the horizon. That would explain why the VIX might spike and stocks might sell off. But if the U.S. economy is actually not doing all that badly, if the consumer is in relatively good health, if confidence is holding up, well, then perhaps stocks might still go down just for a completely different reason. And while everybody might be looking for negative growth as the reason, not seeing it and saying, well, stocks will just keep going higher, perhaps that's not it. Perhaps they will, in fact, go down because perhaps we need a very significant resetting of how they got here. And so maybe we need a sell-off, not for bad economic reasons, but actually for good ones. And that is macro money for today. As ever, we are here every Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at what happened on Wall Street on a given day and what that might mean going forward. I'm back on with Chris for Futures Power Hour on Fridays. That's tomorrow. And on with Tom and Tony on Sundays for First Call, writing for the News and Insights section of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilias Pivek. Thanks very much for joining. See you for Futures Power Hour tomorrow. Take care.